Okay, let's dive deep. Today, we're cutting straight to the most important insights from Asana's first quarter fiscal year 2026 earnings conference call.
That's right.
Our mission here is pretty simple. Just give you the clearest picture possible of what's happening with Asana, straight from the source, their own words on the call.
Exactly. We've gone through the transcript to pull out the key numbers, understand the strategic thinking, and really get a sense of their outlook. It's about getting past just the raw data.
Right, understanding the story. So let's kick off with a quick snapshot of those Q1 FY26 results. What were the headlines?
Well, the biggest headline was definitely on the profitability side. But first, total revenues came in at $187.3 million.
Okay.
That was up 9% year over year and actually came in above the high end of their guidance. So, revenue beat.
A beat on the top line is good. But yeah, here's where it gets really interesting.
Yeah.
They hit profitability for the first time. We're talking non-GAAP operating income here, which means excluding things like stock-based comp. But still, they posted a 4% operating income margin.
Yeah, and that's a massive leap over 1,300 basis points improvement year over year.
Wow, 1,300 basis points.
Yeah. For context, 100 basis points is 1 percentage point, so that's a jump of over 13 percentage points. That's huge progress on efficiency.
It truly is a significant milestone.
Mm-hmm. And their adjusted free cash flow also saw strong improvement, hitting a 5% margin for the quarter. That's up over 700 basis points year over year.
So not just profitable on paper, they're actually generating cash.
Exactly.
And looking ahead to, well, a key area of future growth, they highlighted early momentum with their AI studio. What was the news there?
Right, AI Studio. It crossed the $1 million annual recurring revenue, or ARR, mark in Q1.
Okay, $1 million ARR. That's definitely something to watch, especially given how new it is.
For sure. Early days, but promising.
Let's take a deeper dive then into how they got there, particularly on the revenue side and what's driving that pretty impressive profitability flip.
Sure. So on the revenue side, their core customers, these are the ones spending $5,000 or more annually. Their revenue grew 10% year over year.
Okay.
This group now makes up 75% of Q1 revenue.
Yeah.
And they have 24,297 of these customers.
75%, okay. And the bigger fish?
Yeah, looking even higher up the market, customers spending over $100,000 annually grew by a strong 20% year over year. They're now at 728 customers in that bracket.
20% growth there is solid. So clearly making headway with larger customers. Where else are they seeing growth? Any specific industries standing out?
Yeah, non-tech verticals continue to be a real growth engine. They expanded mid-teens year over year, which is faster than the overall business.
Right.
And now account for over 70% of revenue.
Over 70%. Wow.
Yeah, it shows that diversification beyond their traditional tech base is really working. They specifically mentioned strong performance in manufacturing and energy, media and entertainment, and financial services.
Good spread. And speaking of enterprise success, there was that landmark deal they mentioned, the biggest ever. That's right. It was a 3-year contract renewal worth over $100 million.
Over $100 million.
Yeah, with one of the largest employers globally, actually in the tech sector, surprisingly.
Wow. Okay. $100 million over 3 years is massive. What's the significance of that deal beyond just a huge dollar figure?
Well, management really emphasized this deal validates Asana's capability to power incredibly complex cross-functional workflows at the absolute largest scale.
Cool.
This customer apparently chose Asana as their company-wide standard after a really, really rigorous evaluation process. It signals that Asana isn't just for smaller teams anymore. It can truly be the operational backbone for global giants.
Okay, so biggest total contract value ever. That's the headline. But there was a nuance, wasn't there, around the annual contract value, or ACV, for this specific deal, and how that impacts net retention rate, NRR. Help us unpack that.
Yeah, this is a critical point. While the total value over the 3 years was a huge expansion, the annual value, the ACV, well, it was actually a modest downgrade compared to the previous contract for this specific customer.
Oh, okay. And this specific nuance, along with other customer downgrades they're seeing, it puts pressure on their net retention rate.
Which measures
how much revenue they retain or grow from existing customers year over year. So this downgrade, particularly, will impact NRR in Q2 and likely the rest of the fiscal year.
So they sort of traded a slightly lower annual value for a much longer, stickier commitment and got better visibility into fiscal years 2027 and 2028. That sounds like a strategic trade-off.
It was definitely positioned that way on the call. Getting that long-term visibility is valuable, even if it creates a bit of a near-term headwind on that NRR metric.
Right, makes sense. Okay, let's dig into the profitability side more. Achieving that 4% non-GAAP margin for the first time, super impressive. What were the main drivers behind that sharp improvement?
It was really several factors working together. They've been really focused on optimizing spending, particularly marketing and lead generation,
How's the
by rationalizing programs, basically cutting back on things that weren't working as well, and reallocating resources to go-to-market motions that have a higher ROI.
smarter spending?
Exactly. They're also driving down infrastructure costs, like cloud spend,
Yeah.
optimizing that and being very disciplined about discretionary spending across the board.
Okay.
And another key lever has been optimizing their workforce geography. They've been shifting hiring and backfilling roles to more cost-effective regions like Warsaw and Reykjavik.
Ah, optimizing the onshore-offshore mix.
Precisely. So it's a combination of smarter spending, focusing on efficient growth channels, and really tightening the belt on operational costs.
Yeah.
That discipline clearly paid off in Q1.
No kidding. What does the balance sheet look like, and what are they doing with their cash?
They ended the quarter with about $470.8 million in cash and equivalents. Pretty healthy. They also talked about their remaining performance obligations, RPO, and current RPO, or CRPO, which is basically future contracted revenue. And these numbers were actually impacted by the timing of that huge $100 million renewal we just talked about.
How so? The timing.
Yeah, apparently the billing cycle shifted slightly, pushing some expected Q1 billing into Q2 for that specific deal.
Okay, so the reported RPO and CRPO numbers might not tell the full story because of that one big deal's timing. What do the adjusted numbers look like?
Exactly. So reported RPO was $420.7 million, which is up 11% year over year. But adjusted for that timing shift, RPO would have been about $521 million.
Okay, big difference.
Yeah, that's a 37% year-over-year increase on an adjusted basis. That gives you a much clearer picture of the underlying momentum in future contracted revenue, kind of removing the noise of a single deal's billing date.
Right, and CRPO?
Similar story. Adjusted CRPO, the portion billable in the next 12 months, was up a much stronger 17% year-over-year compared to the reported 7%.
That timing adjustment really changes the perspective on future growth visibility.
Interesting. And they're also buying back stock. Yes, they are. They bought back $15.6 million worth of their Class A common stock in Q1. That was at an average price of $15.59 per share, about 1 million shares.
Okay.
And their board also authorized an additional $100 million for buybacks. That brings the total available now to $156 million, and they removed the expiration date on the program.
So they're committed to it.
Seems like it. They view it as an effective way to return value to shareholders and help offset dilution from, stock compensation.
All right, let's shift gears significantly now to AI Studio and their strategic growth initiatives. We heard about that $1 million ARR milestone early on, but what's the bigger picture and the potential here?
Yeah, management is clearly putting a lot of emphasis on AI Studio. They're seeing rapid pipeline growth and global interest. And a key point they highlighted is seeing instances where the AI Studio ARR alone for a customer is exceeding their traditional seat-based ARR.
Wait, hang on. The AI features are generating more revenue than the number of users in some cases.
I know.
That's a really strong signal.
It is. It suggests the AI capabilities have the potential to become a very significant revenue stream over time, potentially even eclipsing the traditional per-seat model and reducing their reliance on it.
Why are customers adopting AI Studio so quickly then? What makes it stick?
They pointed to three main reasons. First, it's built natively right into Asana workflows, so you don't have to leave the platform or drastically change how you work.
Less friction.
Exactly. Second, it incorporates human-in-the-loop controls using familiar Asana features like approvals, so humans stay in charge of key decisions. People like that control. And third, and this is perhaps the most powerful part, it runs on Asana's work graph.
Okay, work graph. Asana uses that term a lot. For listeners maybe less familiar, how would you explain what that is and why it's so important for AI?
Sure. Think of Asana's work graph like a smart, interconnected map of all the work happening in an organization. It knows about your tasks, your projects, your goals, who's responsible, what depends on what, how it all fits together.
So not just a list of tasks.
No, not at all. Unlike simpler list-based tools, the work graph provides deep, structured context about how work actually flows. And for AI, this is gold. It means the AI isn't just looking at isolated pieces of information. It understands the full picture.
Ah, I see.
This allows it to automate or assist with more complex, multi-step workflows and truly enable what they call human AI coordination.
That makes sense. The AI has a better understanding of the work because of that underlying structure. Can you give us some specific examples from the call of how customers are using it right now?
Absolutely. Woolworths, the big retailer in Australia, is using AI Studio to transform their safety and capital governance process for store changes.
Okay. How?
It helps analyze submissions, automatically route requests to the right people, and provides all the necessary context for quicker decisions. Big efficiency gain there.
Right.
Another example mentioned was an India bakery chain using it to combat fuel theft in their delivery fleet.
Fuel theft. How does AI help there?
By automatically extracting and logging fuel data from photos of receipts snapped by drivers. This creates an audit trail and provides real-time visibility to management, helping prevent losses. It shows really tangible, measurable gains.
Those examples really highlight the focus isn't just on, replacing jobs, but on making existing workflows much faster and more efficient.
Precisely. The core strategy is human-AI coordination. Using AI to augment human capabilities at specific high-leverage points like triaging incoming requests, drafting initial briefs, extracting and analyzing data, but keeping humans involved for their expertise and judgment.
So making workflow faster.
Exactly. And delivering measurable productivity gains. That's the goal.
So what are they doing now to accelerate the adoption of AI Studio across their customer base now that they've sort of proven it works?
They've got a clear plan.
Yeah.
In Q1, they launched the Smart Workflow Gallery.
Smart Workflow Gallery.
Yeah, it offers pre-built AI-powered workflows for common business processes in areas like IT, marketing, operations. Think of them like smart templates based on best practices.
Ah, like jump-starting the AI journey for customers makes it easier to get going.
Exactly. It allows organizations to quickly adopt and scale AI use in everyday work without needing to build everything from scratch.
Smart. What else?
They're also launching AI Studio Plus this quarter. This creates a 3-tier structure for AI Studio pricing.
Okay. Tiers.
Yep. Basic, which is now included in all paid plans but has monthly credit caps. Then Plus, this new mid-tier designed for more scalable usage, especially aimed at self-serve customers. And finally, Pro, for enterprise needs with higher allowances.
So better price-value alignment and an upgrade path.
Right. It should help strengthen NRR by offering clear upgrade paths as AI usage grows.
And what about other ways they're adding value and maybe new revenue streams? Any other add-ons?
Yeah, they successfully launched foundational service plans in Q1. Apparently, those exceeded expectations and generated significant new business revenue already.
Service plans, like support.
Expert support and guidance, yeah. Helping customers maximize their use of Asana, including AI Studio. It improves customer health, ensures they get value, and helps retention. Plus, they have new product add-ons planned, like a resource management add-on coming in Q3.
Okay.
And looking further out, something pretty interesting. They're planning to introduce AI teammates in the second half of the fiscal year.
AI teammates, that sounds intriguing. What are those supposed to be?
They describe them as goal-oriented, kind of agentic collaborators that leverage that work graph context we talked about.
So like AI assistants within Asana.
Sort of, but maybe more proactive. The idea is they act like persistent coworkers, keeping multi-step work moving forward with minimal human guidance.
Like what?
For example, an AI teammate could manage review and approval processes, extract data via APIs, or draft materials for a task, all while updating the status within Asana automatically.
Okay, that could be powerful. And how could these AI teammates impact revenue?
Well, this is where they see a potential to unlock usage-based revenue streams that go beyond the traditional per-seat licensing.
Ah, pay for what the AI does.
Potentially, yeah. As AI teammates handle more tasks and automate more complex workflows, the value delivered is higher. They envision this could be priced based on usage, becoming a significant future growth driver, separate from just user counts.
Very interesting. Okay, how does Asana stack up competitively then, especially with seemingly everyone talking about AI now?
Well, they were quick to highlight being named a leader in the Forrester Q1 Collaborative Work Management Wave.
Okay, external validation.
Right. They see this as proof of their strength in the enterprise scalability, security, vision. They contrast their work graph and integrated approach with standalone AI agents or point solutions. The argument is that Asana's ability to handle diverse, critical use cases across different departments, providing that deep context, allows for broader, more successful enterprise deployments.
And potentially consolidation.
Exactly. They see opportunities for companies to consolidate multiple point solutions onto Asana, arguing that data reliability and cross-team collaboration is better because of the work graph. AI Studio could be a catalyst for that.
Right. Makes sense. Okay, let's broaden out now and look at the investor context, the demand environment, their outlook, and maybe some other themes from the call. What's the read on the overall market demand right now?
They said there hasn't been a material change in demand compared to the last few quarters. So stable overall. However, they are starting to see early signs emphasis on increased buyer scrutiny and some elongation in decision cycles.
Meaning deals are taking longer?
Yeah, especially for larger deals or initiatives involving software consolidation or big stack transformations. People are thinking a bit harder, taking a bit longer. They did stress their overall pipeline remains healthy, though.
Okay, so some caution creeping in. Given that environment and those early signs, what's their guidance for the next quarter and the full fiscal year?
For Q2 FY26, they guided revenue to be between $192 million and $194 million. That implies about 7% to 8% year-over-year growth.
Okay, and a full year.
For the full fiscal year 2026, they updated revenue guidance to a range of $775 million to $790 million. That represents 7% to 9% year-over-year growth.
That's a revenue range there. What does the difference between the low and high end signify? What are they factoring in?
Good question. The range reflects two potential scenarios in their planning. The upper half of that guidance assumes the current, relatively stable macro environment continues.
Okay, status quo.
The lower half, however, anticipates potentially increased macroeconomic risk. It factors in those potentially longer sales cycles, more scrutiny, and just a generally more cautious procurement environment, especially impacting their larger deals and maybe the tech sector specifically. They're basically baking in risks that they admit aren't fully visible yet.
So the lower end is explicitly accounting for a potential downturn or at least a slowdown in deal velocity.
Got it. What about profitability guidance? Did that also reflect the efficiency gains we talked about? Yes, and they actually raised it. They raised their full-year non-GAAP operating margin guidance to at least 5.5%. That's up from their prior guidance of at least 5%.
Nice bump.
Yeah, and they expect to see sequential margin improvement throughout the year as well. For Q2 specifically, they guided non-GAAP operating income at $8 million to $10 million, which is a 4% to 5% margin. And full-year non-GAAP EPS guidance is $0.22.
And did they express confidence that they can maintain those profitability levels even if the macro environment does get tougher, like in their lower end scenario?
They did. They feel confident they have levers. They can pull things like further GTM productivity improvements, maybe more vendor rationalization, continuing to optimize their geographic workforce mix.
More efficiencies.
Right. Levers that would allow them to preserve profitability at the guided levels without sacrificing strategic investments, particularly in areas like AI that are key for future growth.
Okay, that's reassuring. Let's circle back quickly to net retention rate. NRR, you mentioned it's expected to face pressure due to those downgrades and that large deal's ACV structure. What were the current NRR numbers they reported, and what's the specific outlook?
Sure. Their overall NRR on a trailing four-quarter average basis was 95%.
Okay.
Core customer NRR was slightly better at 96%, and the $100K plus customer NRR was also 95%. They did note that NRR was actually stable in the quarter itself, and importantly, logo churn, meaning customers leaving entirely, actually improved across all cohorts.
So customers are less likely to leave entirely, which is a good sign of platform stickiness.
Right.
But those who stay are sometimes spending less, plus you have the impact of that one big deal. That's the NRR headwind.
That's exactly it. So they expect NRR to be pressured in Q2, and likely for the remainder of FY26, precisely because of that continued downgrade pressure. Particularly, they called out enterprise and mid-market segments, and of course, the explicit impact of the modest ACV downgrade on that very large renewal.
But they're optimistic long-term.
They expressed confidence that long-term NRR will improve. They pointed to investments in customer success teams, the potential of AI Studio upsell, new add-ons coming online, and work they're doing on price-value alignment. But in the near term, yeah, that NRR headwind will make the impact of strong new business and channel growth less visible in the overall reported revenue growth number.
Got it. Okay, beyond the core financials and product strategy, were there any other interesting themes or discussions that came up on the call?
Yeah, a couple of things. They gave a brief update on the CEO search, basically said it's ongoing, and they are taking a patient approach to find the right leader. The current CEOs are committed to staying until a successor is in place and sounds excited to partner with the new leader on product and AI strategy.
Okay. Steady as she goes there. And the current CEO also offered some thoughts that went a bit beyond the typical earnings script, right? About the future of work and AI's societal impact.
Yeah, that definitely stood out. He shared his perspective that AI is, already here and society isn't really fully prepared for the potential disruption. He touched on potential job displacement and even mentioned that addressing it might require solutions like wealth redistribution, while also acknowledging the current political climate isn't exactly conducive to those kinds of discussions.
Wow, that's pretty frank for an earnings call.
It was. His advice for young people was interesting too. Focus on developing specialty skills that are harder for AI to replicate. And he positioned Asana's role in this whole transition as making AI tools easy, safe, and secure for organizations and employees trying to navigate these changes. It was a notable moment of broader commentary.
It certainly is a complex and important issue to think about. Finally, did they also discuss the opportunity for work management consolidation?
Yes, they did. They see a real opportunity for companies to consolidate multiple point solutions onto Asana.
Why Asana specifically?
They argue that because of the work graph, Asana provides better data reliability, better context, and enables truly cross-team collaboration in a way that disparate tools just can't. And they believe AI Studio can be a major catalyst for this consolidation.
How so?
Because its integrated nature and ability to drive value through sticky AI-powered workflows makes consolidating onto Asana a much more compelling proposition than trying to bolt standalone AI tools onto other, maybe less capable work management systems.
Gotcha. Okay, that pretty much wraps up the core insights from the call itself. Now, before we finish this deep dive, it's time for our This Is Not Financial Advice segment.
Yes, the all-important disclaimer. What we discuss here is purely for illustrative and entertainment purposes only. We're exploring potential interpretations based only on the earnings call narrative we just discussed. We are absolutely not financial advisors.
Definitely not.
And this is not a recommendation to buy, sell, or hold any securities whatsoever. Please do your own research.
Absolutely. With that firmly in mind, let's entertain an outrageous but plausible trade idea based on what we heard today. Picture a hedge fund analyst pitching this to their investment committee.
All right, let's hear it.
The idea. Go long Asana. The core bet here is that the market, and perhaps even management's own cautious guidance, might be seriously underestimating the speed and scale at which AI Studio's monetization could inflect upwards.
Betting on AI adoption speed.
Exactly. The thesis is that this AI revenue could grow unexpectedly fast and significantly offset those headwinds. We talked about the NRR pressure, the broader macro slowdown, potentially sooner than is currently priced into the stock.
Okay, lay out the plausible part of that thesis first. Why might this happen? What are the supporting points from the call?
The plausible argument rests on a few pillars. One, AI Studio crossed $1 million ARR very quickly, showing real early adoption. Two, it's built natively, making it sticky, and those customer examples demonstrate clear ROI on real business problems.
Right, the Woolworths and bakery example.
Precisely. Three, the systematic product launches this year, the Smart Workflow Gallery to boost adoption, the AI Studio Plus tier to expand reach to self-serve and mid-market. They directly address potential friction points and open up monetization. Four, the upcoming AI teammates offer a clear path to unlocking usage-based revenue, moving beyond the NRR challenges tied specifically to seat counts. Five, that huge enterprise renewal, despite the ACV nuance, confirms Asana's capability and scale and provides a massive installed base where AI Studio can expand significantly in the future.
A big target pool for upsell.
Exactly. Six, the improved logo retention across cohorts suggests the fundamental platform stickiness is strong, creating a solid base for that upsell and cross-sell. And seven, management has shown operational discipline by raising margin guidance, suggesting they can manage the business effectively.
Okay, so there are definitely real building blocks there for AI success and overall efficiency. That's the plausible case.
Yeah.
So where does the outrageous part come in? What makes this a risky non-consensus bet?
The outrageous part is really the speed and magnitude aspect. It's betting that the combined impact of all those AI Studio catalysts happens so fast and at such a scale that it materially overcomes the explicitly guided NRR pressure from downgrades and the potential broad macroeconomic deterioration, and does so within the next, say, 6 to 12 months.
Faster than management is guiding for, essentially.
Much faster. It assumes those early signs we heard about AI Studio ARPU exceeding seat ARPU become widespread across the customer base much quicker than cautious expectations might suggest. It's essentially betting that the lower end of management's revenue guidance range, which explicitly factors in macro risk, might turn out to be too conservative because it underestimates the potential upside from a rapidly accelerating AI revenue stream this year.
So the pitch is basically betting on an AI hypergrowth scenario that manages to overwhelm the known guided-for headwinds much faster than anyone, including potentially the company itself, currently expects.
Precisely. You acknowledge the risks, the macro is real, NRR pressure is real and guided for. But you argue the market is potentially overlooking or underappreciating the sheer leverage from the AI Studio product cycle and the deliberate go-to-market initiatives happening right now. You position Asana as uniquely capable for human plus AI coordination because of the Work Graph, validated by Forrester, suggesting a long-term leadership position that justifies a higher valuation if, and it's a big if, that AI revenue stream inflects with surprising speed and scale. The bet is purely on the upside velocity of AI adoption outpacing the downside forces in the near to medium term.
A classic growth versus value, momentum versus fundamentals kind of pitch.
Fascinating to think about the potential.
Though again, absolutely, positively not financial advice. Please do your own homework.
Always, always do your own homework.
So to wrap up this deep dive into Asana's Q1 FY26 earnings call, the key takeaways really seem to be a huge milestone achieved with first-time non-GAAP profitability.
Definitely number one. Really strong early momentum and a clear strategic pipeline laid out for AI Studio and management actively navigating those macro uncertainties and near-term NRR pressures while still making strategic investments for long-term growth and efficiency.
Yeah, it paints a picture of a company working hard on execution, really pushing innovation, particularly in AI, even as it faces some of those external headwinds that are affecting pretty much all software companies right now.
Definitely. We'll leave you with this thought, kind of building on what we discussed today and maybe the CEO's comments. Beyond just company financials, consider the broader impact of widespread AI adoption on the future of work itself. What could truly seamless human-AI coordination look like in your own day-to-day workflow? It's certainly something worth pondering.
Good thought to end on. Thanks for joining us for this deep dive.
We'll catch you on the next one.